Hello and welcome to Hoosier Property Taxes, the local impact. My name is Addison Pollock and I'm the Director of Community Engagement with AARP Indiana. We're hosting this event today because property taxes are critical to the well-being of our communities, but older Hoosiers cannot always afford them. This is especially true when they are experiencing property tax increases on top of other rising monthly expenses like utilities, groceries, and healthcare. During 2025 state legislative session, AARP Indiana was fighting for legislation to keep property taxes affordable at the State House. As part of our commitment to keep Hoosiers 50 plus informed and prepared, we want to make sure we take time today to walk you through some of the aspects and changes you can expect to see as a result of Senate Enrolled Act 1 from last year's legislative session. While this topic can oftentimes feel complex and complicated, we hope that you find today's event informative and useful as you plan ahead for how these changes will impact you on a local level. To kick things off this afternoon, I want to introduce John Montrestel, Vanderburgh County Council President and Councilor for District 4. He will share some thoughts and insights into the anticipated impacts on our property taxes locally.
John Montrestel.
Oh, yes. I'm about to get to you, John, just a moment. John Montrestel has served 12 years on the Vanderburgh County Council, including 5 terms as council president. In addition to his public service, he serves as government sales manager for Anchor Industries and previously served as president of the Evansville Convention and Visitors Bureau, known as Explore Evansville. John is a graduate of University of Evansville, and I would like to now welcome Council President Montrestel. Take it away.
I know we just did a check, but I cannot hear you. If you give me a thumbs up, I'll go ahead and start. Okay, good afternoon, and thank you for the opportunity to speak about the financial impacts of Senate Bill 1 and what it means for Vanderburgh County. The county is already experiencing approximately $10 million annually in circuit breaker losses, and we are planning for an additional $6 to $9 million in losses beginning in 2026. Approximately 87% of those losses affect the county's general fund, with the remaining impact spread across the health department, reassessment, the cumulative bridge fund, the county cumulative development fund, and the museum. Looking ahead, additional revenue reductions are expected in 2027, with changes to the business personal property tax and the gradual phase out of the homestead deduction through 2031 will likely continue to increase circuit breaker losses. While the exact numbers are still being finalized, it's clear that local governments will face several years of financial uncertainty. In response, the County Council is taking a disciplined approach to managing taxpayer dollars. We have tightened spending, carefully review vacant positions before refilling them, and are limiting vehicle and equipment purchases, and will continue evaluating every expenditures to ensure essential services remain our top priority. Fortunately, Vanderburgh County is in a strong position. We have consistently maintained balanced budgets, built healthy financial reserves, and currently have the 15th lowest local income tax rate among Indiana's 92 counties. Beginning in 2027, County Council will also have the authority to set the local income tax rate for implementation in 2028, providing an additional tool to address future needs if necessary. That conservative approach was evident during our most recent budget process. The Council reduced the overall 2026 budget request by more than $3.2 million. Including nearly $2 million from the general fund, demonstrating our continued commitment to fiscal responsibility. Senate Bill 1 presents significant challenges, but I'm confident Vanderburgh County is well positioned to meet them. Through careful planning, responsible budgeting, and sound financial management, we will continue protecting taxpayer dollars while providing the essential services our residents depend on. Thank you. Thank you, Addison.
All right. Thank you, Council President. Really appreciate that. And apologies for the technical difficulties, but that's a live event for you. We appreciate your perspective and your leadership in Vanderburgh County. Next, I want to welcome, the next welcome I have for you this afternoon is AARP Indiana's very own volunteer, my friend, Vicki Small, team leader for the local work we do here in Evansville. And she's also a member of our volunteer executive council and volunteer state legislative team. Vicki, good afternoon.
Hey, good afternoon, Addison. Thank you. And thank you, County Council President Montrestel, for your comments. Again, as Addison said, my name's Vicki Small, and I'm the co-leader for the AARP Indiana volunteer team here in Evansville. You know, we older adults, by and large, understand the importance of taxes in general, and specifically property taxes, because, as Addison said, property taxes are critical to the well-being of our communities. Building on this idea, however, is the reality that many of us older adults face current incomes often fail to keep pace with the rising cost of living, especially considering that for most of us, our high earning years are behind us. So for many of us, escalating expenses, including property taxes, can quickly outstrip our limited incomes, and they create significant financial strain. There are many Hoosiers who would like to see even more targeted property tax relief. At the same time, we understand that changing property taxes for one group can shift the burden to others. And if those changes go too far in any direction, it becomes harder to maintain the shared investments our communities and ourselves depend on. So regardless of our personal perspective, many of us face a difficult balance, managing limited funds, maintaining a comfortable quality of life, and worrying that rising taxes, especially property taxes, could force us to give up things we've worked very hard to secure. So that's why today's conversation and AARP's focus on this multifaceted issue is so important. So with that in mind, I'll turn things back to Addison.
All right. Thank you, Vicki. Look forward to hearing more from you later in the program. Now let's move into the meat and potatoes of today's program. What changes can you expect to see from your property taxes going forward? To that end, we have a wonderful lineup of guests and experts for the remainder of today's program to break down this for you in a way that makes sense. Our first guest is Larry DeBoer. Larry is Professor Emeritus of Agricultural Economics at Purdue University. He retired in 2021 after 37 years at Purdue. He's an expert in state and local public policy, particularly in issues related to Indiana property taxation. So thanks for being here, Larry, and please take it away.
Hi, I'm Larry DeBoer, Emeritus Professor of Agricultural Economics. Emeritus means has been or retired. And I'm very pleased to be with you here today to speak about the property tax reform that is ongoing in Indiana. We had some very interesting things happening to the property tax after the pandemic, and the legislature responded in 2025 with a great big property tax reform. I think the third major property tax reform since 1973. And so it's going to phase in over the next 5 years out to 2031. So I think it behooves us to take a look at what we can expect, what is scheduled to happen, what impact that might have on local governments, and what impact it might have on homeowners that I know many of you are. So let's take a look now at Indiana property tax reform and see what's likely to happen. First of all, the pandemic and the property tax. Hey, why do we need property tax reform? Well, the pandemic came along and really caused some big changes. And the root of that change was what happened to property values. And we've got good measures of home prices in Indiana. This is the average transactions price of a home in Indiana, and it's the percentage change from year to year. And you see in the double O's in the 2000s, the increase was between about 2.5% and 5% per year. And that's been true in Indiana for a long, long time, going back into the 90s and the 80s and the 70s. And that's the kind of increase we were used to. Then came the Great Recession in 2007, 8, 9, and home values actually declined for a while, and that was unusual. But after that, they increased at an increasing rate. They accelerated until by the end of the 20-teens, we were seeing increases above 5% per year. Very unusual, unusually high for Indiana. Then came the pandemic, and you see for a couple of years there, we had double-digit increases in home values. And even since then, in 25, 24, and 23, we've seen increases above 5%, extraordinary increases in home values. In fact, over that period of time, since 2020, home values on average are 57% higher than they were back in 2020. So if you've been following the home prices in your neighborhood or the selling prices on real estate sites, and you're wondering, when did I move to California? Well, that's what it looks like, isn't it? Prices that we were not used to are what we're seeing in Indiana right now. Well, you know, the property tax is a tax on the value of property, and the value of your property was going up. And so sure enough, the net assessed value of property as valued by the assessors for the property tax, that went up too. Now you see some pretty big bars off to the left there in 2007 and 2009, and that had to do with the Daniels reform, and that's what we were talking about 20 years ago. But starting in the Great Recession, you see that home values actually declined in 1 year and increased very little after that. But then home values began to accelerate. The increases in assessed value, and this is not just home values, but all values of property, increased at more than 5% in 2022. And then the pandemic came, and we saw an increase of almost 50% in 2023, and then extraordinarily large increases in the years after that. One thing that tells you is that our assessing system works. Indiana's assessment standard is called market value in use, which means what the assessors aim to do is to value your home and all other property based on what they think it would sell for if it went out into the market in a free and fair sale for the same use to which it's put now, right? So market value in use is what we say. And so you would expect if the assessment system was working and actual market values went up, that assessed values should go up too, and they did. So our assessment system is working. Now, one thing to know is that there's a 2-year lag between what happens in the economy, what happens to actual selling prices, and what happens to your property taxes. And that's because, well, for example, home values went way up in 2021. Assessors looked back in 2022 for the only data they had, which was data from the past. And so in 2022, the assessed values reflected what happened in 2021 with market values. And then those values in 2022 were the basis of property tax billing in 2023. So the 2021 shock to home values due to the pandemic showed up in your property tax bills in 2023. And that affected your tax bills too, right? And what we see here are the net levy after credits. And so this is both the revenue collected by local governments and the tax bills that people have paid. And you can see the pattern looks pretty much the same as it did with assessed value, and look pretty much the same as it did with home values. We see increasing rate of increase throughout the 20-teens, and then great big increases in the levy in 23, 24, and 25. And the tax levy, that's what we call revenue, the revenue that's actually collected from the property tax. You know, the property tax levy that local governments can set is rather stringently controlled by the state. There is a maximum levy, and the increase each year is controlled by the maximum levy growth quotient, but not the whole levy. The whole levy is not under that maximum, and in particular, debt service and school referendum rates are outside of that maximum, and those were the levies that went way up as a result of the rise in net assessed value. So the increase in assessed value, yes, did cause an increase in taxes and an increase in the revenues that local governments collected. Well, it was at that point that the legislature looked and said, hey, we got to do something about this, and we got the tax reform of 2025. Now, the tax reform it passed in 2025 was in Senate Enrolled Act 1, and that's why we call it SEA 1. And it phases in, as you see, from 2026 to 2031. SEA1 provisions that kick in this year include the supplemental homestead credit. Now, this is the tax cut you're going to feel this year, right? And it's a 10% cut in your tax bill up to $300. So you calculate the whole tax bill, or the treasurer calculates the whole tax bill, and then they knock 10% off up to $300. So that's a credit that is going to start in 2026 and continue on into the future. We're going to eliminate the 30% floor on new business equipment assessments. Now, that homeowners don't have to be concerned with that, but the 30% floor limits the amount of depreciation that firms can take on their business equipment for property tax purposes. And at the moment, there's a floor of 30%. They can't depreciate more than to 30% of the value of their property. We're going to remove that from here on in. And so by about the year 2030, businesses may begin to see lower taxes as a result of this. We're going to use a 9% capitalization rate on farmland assessments. We assess farmland based on a capitalization formula where you take a measure of farm income and divide it by an interest rate. The interest rate we've been using is 8%, but now we're going to use 9% for a while. And if you increase the denominator of a quotient like that, the value goes down, and that should reduce the value of farmland by about 11%, actually. And then we've changed the calendar on school referendums. Up till now, school referendums where you propose a property tax increase and the voters within the school corporation get to vote on whether to approve it or not. In the past, we've been able to do school referendums in any year, and in the May primary election or in the November general election. From now on, it's only going to take place in November of even-numbered years. So that's November of general elections. That's 2026 is one of those years. And so we're not only going to see the normal number of referendums in November, we're going to see the ones that would have taken place in May, and we'll see the ones that would have taken place in May and November of next year. So I've heard consultants say there could be 50 or even 100 school referendums on the ballots across the state this November. The maximum we've ever had before is 18, I think. So that's going to be quite a sampling of school referendums. On into the future, next year, we're going to create a $2 million personal property exemption, which means that any firm whose property cost less than $2 million to buy, that is the equipment property, not the land and buildings, just the equipment. If it costs less than $2 million, they don't have to pay property taxes on it. If it costs more than $2 million, then you do have to pay property taxes on it. So that kicks in 2027. In 2029, we're going to completely reform the local income tax system, and that will have a little bit of an effect on property taxes, as I'll show you here in a little bit. By 2031, it will be fully phased in. Now, I think the most important thing that happens as a result of SEA1, especially for homeowners, is the deductions. And there's three deductions we need to talk about. First of all, the standard deduction. Standard deduction is a fixed $48,000 that is subtracted from the assessed value of the home. So the assessor sets the assessed value, and you subtract $48,000 before you apply the tax rates. Second, as you can see, that one's going to phase out. That's going to be reduced to zero by 2031. So that deduction is going away. The supplemental deduction is 37.5% in 2025 and 40% this year. It's going to go up to 66.7%, or 2/3. And that's a percentage that is subtracted from the value of your, the assessed value of your home after the standard deduction is applied. So both of those things reduce the taxable value of your home. Finally, we're going to introduce an entirely new deduction for rental housing and second homes and farmland. And they've never had a big deduction before, but that's going to phase in. It's going to be 6% this year in 2026, and by 2031, it'll be 33.4%. So that one is phasing in. So one of the main things that SEA1 does is to increase the deductions on most homeowners and on rental housing and on farmland. So a rather large chunk of the tax base of the property tax is going to see increased deductions, which means less of the value of that property will actually be taxable. Well, let's take a look at what might happen with assessed value and the tax rates. And before we do that, though, let's think of two different ways of looking at tax policy. Right? There's the way that the legislature does it, and it's absolutely appropriate for the legislature to do it this way, and that's to compare the results of their policy to a forecast or estimate of what would have happened had the policy not been changed. Right? So what you're doing is saying, hey, here's what the world would have looked like had we not changed the policy. Here's what the world actually looks like. The difference between the two is what the policy did. Apart from anything else that might have happened anyway, here's what the policy did. And that works as a way to look at the impact of policy. But people, you and me, we don't think that way. Right? We don't compare our tax bill to some alternate universe where a different policy would have been used to determine that tax bill. No, we compare our tax bill this year to what our tax bill was last year. Right? So there's two ways to look at it. You're looking at a comparison of the policy to what would have been, or a comparison of the policy to what was. Let me tell you, it's perfectly possible for something to look like a tax cut when compared to what would have been, and a tax increase when you compare it to what was. So it's important to keep those two straight. And I'll be telling you as we go which point of view I'm using. All right. Now let's take a look at some data. And here's a table of data. Indiana assessments in 2025 if SEA 1 had fully phased in. So what I'm going to do is take the actual data from 2025 and I'm going to ask the question, what would the world have looked like if SEA 1 had been fully in effect in 2025? What would assessed values have looked like? What would the levy have looked like? What would tax rates have looked like? And I'm going to apply it to the 5 categories of property that we usually use here in Indiana. And the first one, as you can see, is homesteads. Now, homesteads have those 2 deductions, the standard deduction and the supplemental deduction. There are a few smaller ones as well. And those 2 together reduce gross assessed value, the value that the assessor puts on your property, to net assessed value, the value that's actually taxed, by about 50%. Cuts it in half. We only tax half of the value of homes in Indiana as of 2025. But we're going to now apply a 2/3 deduction, right? 66.7% is going to be the supplemental deduction by 2031. And if we had applied that, you can see that net assessed value would have been about 34% lower than it actually was in 2025. So homestead net assessed values are going to be down substantially, or would have been down substantially from what they were actually in 2025. What about non-homestead residential and farmland? They're grouped together under that 33.4% deduction. As you can see, in 2025, 95% of rental housing, non-homestead residential, was actually taxed, and 99.7% of farmland was actually taxed. Farmland got hardly anything in deductions. Now they're going to get 33.4%. So this is brand new, and I suspect they're very excited about this. It's going to phase in by 2031, and of course, being a 1/3 deduction, is going to reduce the assessed value, or would have reduced the assessed value that is taxable in 2025 by about 1/3. How about business real property? Well, business real property got nothing from SEA 1. As you can see, about 77% of business real property, and this is land and buildings of businesses, about 77% was actually taxed, and the difference are the abatements that we give them to improve, to enhance economic development. That's going to remain the same. They didn't get an additional deduction on their land and buildings, but business personal got that new $2 million exemption. That is, the firms that have less than $2 million in equipment cost, the cost to acquire the equipment, that they won't have to pay. And some estimates have said that about 90% of all businesses won't have to pay personal property taxes anymore. The thing is, though, most of the personal property is owned by really big businesses, right? It's not your hairdressers and your travel agents that own all the personal property, the computers and the hair dryers and the chairs. No, that's not a lot of personal property. That's less than $2 billion. They won't have to pay on that. Where the personal property is with the big manufacturers and the steel firms and the utilities who have way more than $2 million. And what that means is that even though 90% of all the taxpayers may be exempt, we'll probably only lose a maximum of about 28% off of net assessed value. Now, we can't get the number exactly because the acquisition cost of business equipment, which is what the exemption is about, that's private information and it's not released to the public. We can estimate from assessments, but we don't have the actual data. So the 28%, that's the maximum amount that we're likely to lose from the personal property tax base. Add it up, and what do we get? 26.9%. That is, the tax base, had SEA 1 been fully applied in 2025, the tax base would have been 27% lower than it actually was. Now, what does that mean over time? What does that mean over time? Because after all, gross assessed value is going to continue to increase. There's going to be new construction. There's going to be land changed from lesser uses to more expensive uses. Population is going to increase. And of course, property values are going to rise as well. So all of those things are going to increase gross assessed value. But with a 27% decrease, as you see in this table, what it means is that gross assessed values are going to have to grow by about 3.5% to 4% per year just to keep net assessed value constant. That is, if it grows more slowly than that, net assessed value is actually going to fall from 2025 to 2031. All right, so keep that in mind from what we're about to say next, which is the levy. The levy is the revenue that's collected from the property tax that local governments raise to deliver their services. But the property tax is different from all the other taxes in that we recalculate the tax rate every year. And there's a different tax rate for every unit of government. And across the state, there's more than 2,000 different property tax rates, depending on where you live and which governments actually serve your service needs. Back in 2025, we raised $12.5 billion. All these numbers here are in millions. $12.5 billion in the levy. And so to calculate the tax rate, what we did was to take the levy and divide it by net assessed value, $524 billion, and express it as dollars per $100 assessed value. So you read that average tax rate there as $2.38 and change per $100 assessed value. Now, if you want to think of it as a percentage, that's fine. You can do that. It's the same thing as a percentage. But if you want to talk to a local official or a legislator or something like that, you want to use the terminology we use, which is $2.38. So that's the tax rate. Now, what happens? Well, now the net assessed value is going to be lower, but we're still going to try to raise the same amount of levy. That's what would have happened had we applied SEA 1 in 2025. The tax rate would have been $3.25, almost $3.26, or the tax rate going up 36.7%. Now, over time, what's going to happen? Well, over time, the levy is going to rise 3, 4, 5% a year, as it always does, to handle inflation and population growth. But assessed value is not going to rise. Net assessed value is not going to change very much because of all the new deductions all the way out to 2031. And so the tax rate is going to go up year after year after year. And as you can see, 36.7% is where we'd end up had we applied it in 2025. Now, $3 turns out to be important under the new system. Let's suppose, and let me show you why, by taking a homestead worth $300,000. And I'm taking that because it makes the arithmetic easy. We have in our Constitution something called the circuit breaker. It's a cap on your property taxes. The cap equals 1% of the gross assessed value. That is the assessor's estimate of what your property is worth. So 1% of $300,000 would be $3,000. You can't pay more than that on a house valued at $300,000. Now, the school referendum rates are outside of this system, so you pay extra for that. But for everything else, the cap is $3,000. Now, if we have a deduction of 66.7%, The deduction amount will be just over 200,000, and the net AV after subtracting that deduction would be just under 100,000. Now, what kind of rate would produce a tax of $3,000 on a net AV of $100,000? Well, it's a $3 rate, a little bit more than $3. So if the rate goes above $3, the tax bill would go up over $3,000, but you can't pay more than $3,000 because of the circuit breaker. The property tax on homeowners is maxed out when the rate goes above $3. If you do that same calculation for residential and farmland, they've got a circuit breaker rate of 2%, but they've got a deduction of 1/3. Arithmetic works out the same. $3 rate. You get a rate above $3, and no more property taxes can be raised from landlords, non-residential rental property, or I should say non-homestead rental property, and farmland. And likewise with business, they have no new deduction, but their cap rate is 3%. You go above $3, they don't pay any more property taxes. Now, what did we just say might happen to the tax rate? We just said it might go above $3. This is one of the concerns that local governments have. If a lot of rates go up above $3, you've maxed out the property tax. And will that decrease the amount of revenue that they receive? Could very well be. Now, an awful lot of local governments have hired consultants to try to project forward to see what impact this is going to have. So they're worried about that. They're worried about the supplemental homestead credit, that 10% reduction in your tax bill, which is unfunded. That is, nobody's replacing that revenue. It just goes away. It's part of your tax bill that you're not going to pay. So they're going to lose that revenue. And then think about the schools that have the referendum rates. The referendum rates are fixed. They expected to apply that referendum rate to an ever-increasing net assessed value, which will not happen now. So the referendums are going to raise less revenue than they thought. So all of those things have got local governments concerned about how they're going to deliver services with this new property tax system. Well, let's take a look at your tax bill. Right? Let's take a look at homeowner taxes. And, you know, the information I'm going to show you here, you've got it for your own home. Because every spring, along about the time that tax bills go out, the treasurer, the county treasurer, sends you a TS1 form, which is an 8.5 by 11 page. And you've probably looked at it and said, what is this? It's just chock full of numbers. What it is an explanation of how we go from the gross assessed value of your house, that is the value of your house, all the way down to your tax bill. We can use that information to compare what happened to your taxes, or what happened to the typical tax bill in 2025, what would have happened under the old system by 2031, and what just might happen under SEA 1. So let's take a look at what the tax bill looked like in 2025. And I started with a gross assessed value, that is the value of the home, the selling price of the home, of $234,500, $234,500, which is the average gross assessed value of a home in Indiana in 2025. We subtract off the $48,000 standard deduction, and that gives us $186,500. We subtract off 37.5% of that $186,000, and that's $69,938. And we subtract both those deductions from the gross assessed value, we get a net assessed value, or taxable assessed value, of $116,563. Just about half of the gross assessed value. And we saw that in the actual data, where net assessed value was about 50% of gross assessed value statewide. Then we apply the district tax rate. I've used the average tax rate here at $238. That gives you a gross tax bill of $2,779. But you don't pay that. At least in 59 counties, you've got a LIT credit, and LIT is local income tax. And in those 59 counties, they've got a tax rate, an income tax rate, which raises money, which they then use to buy down the property tax for homeowners and other taxpayers sometimes. And the average credit for those 59 counties is 16%. So that revenue does get replaced, right? The $445, which is 16% of $2,779, that $445 is revenue that you don't pay on your property tax, but gets replaced for local governments from the income tax that is raised. But that leaves your tax bill at $23.34. Now we're going to compare it to the tax cap. The tax cap is 1% of $234,500, which is $23.45. And as it happens for the average taxpayer, it is just under the cap by $11. So you pay the $22,334, and that is your final tax bill. Now, what would happen if we kept that system and moved forward to 2031? Well, what happens between now and then? Well, recent experience tells us that the value of homes are going to keep going up. The gross assessed value is going to rise. I picked a 5% annual increase. Will it be 5%? Well, that's kind of what it was for the few years right before COVID. So maybe, right? But we need a number, so we'll take 5%. It's at least plausible. We subtract the 48, we subtract the supplemental, and we end up with a taxable net assessed value of $166,408. Notice that's a little more than half of the $314. The reason why it's more than half is that the homestead standard didn't increase, right? It's now a smaller percentage of the value of the home. Use the same district tax rate of $238. Tax rates have been relatively stable over the last several years. It's assessed value that's going up, not the tax rates. That's why your tax bill has risen. So we'll use the same district tax rate. It's easy to do. And we'll see that the gross tax bill is $39.67. Lit credit of 16%, subtract $635, and that gives you a really beautiful number, $3,333. We compare that to the tax cap, and we find, oh boy, 1% of $314 up top is $3,143. The tax bill after lit credits is higher than your tax cap, and so you get a tax cap credit of $190. That is revenue that you do not have to, that is tax bill you do not have to pay, and revenue that the local governments do not receive. So that's a revenue loss for local governments. That brings the tax bill down to $31.43. Now, what's actually going to happen, right? That's what would have happened had the old system remained in effect. What's going to happen with SEA 1? Well, nothing different happens to gross assessed value. It just increases 5%. Homestead standard deduction goes away, disappears. It's down to 0. But the supplemental deduction percent goes up to 66.7. The supplemental deduction gets very large, and the net assessed value is $104,646. That's about $62,000 lower than it would have been in 2031, but it's also lower than it was in 2025. Right? It's lower by about $12,000. So think about this from local government's point of view. This big piece of their tax base, homes, going to be declining in value over the next 5 years. So the tax base is going to be shrinking for local governments. What's going to happen to the tax rate? Well, it's going to go up. We said about 37% from the other simulation, so let's use that. That puts it up to $3.12, above $3. A gross tax bill of $3,268. One of the things the local income tax reform is going to do is to eliminate the lit credits. As of 2029, lit credits are gone. So we don't have that. We look at 1% of 314, we get 3143. That is higher than the tax bill after lit credits by $126. So you get a tax cap credit of that amount. That brings your tax bill down to $3143. That's the same as it was in 2031, but now we've got the supplemental homestead credit rate of 10% up to $300, and 10% of $3114 is $314. So you get a $300 reduction. That's $2843. All right. Is this a tax cut or is it not? Compared to what would have been, it's a tax cut of $300. Compared to what was, the tax bill is $509 higher. Right? It's lower than $3143 by $300. It's higher than $2334 by $509. So is this a tax cut or is it not? Yes, it's a tax cut. Actually, compared to what would have happened, yes, it's a tax cut. But what it means is that your taxes are going to go up more slowly than they would have. Now, they might go down in 2026, or you know by now whether they have gone down in 2026. I think a majority of homeowners, maybe a bare majority, but a majority of homeowners will see lower taxes in 2026 than they saw in 2025 because of the supplemental homestead credit rate, which kicks in all at once in 2026. After that, though, we're likely to see continued increases because of rising gross assessed values and the rising district tax rate. That's for the average homeowner, and I think for most homeowners will look like that. But what about lower valued homes in rural areas? Let's have a home that starts out at $80,000 in 2025. And I can hear you folks in urban areas and suburban areas saying, $80,000, where are their homes valued at $80,000? I'll tell you where. In rural Indiana, that's where. In Jay County, for example, which is a rural county, Portland, Indiana is the county seat. It's northeast of Muncie on the Ohio border. In Jay County, about a third of all the homes are valued at $80,000 or less. So this is important in rural Indiana. And if we're talking about taxes outside of cities and towns, we're talking about low tax rates like a $2 rate here. Look what has happened to gross assessed value to net assessed value. Under the old system, net assessed value was reduced by 3/4 because $48,000 is a big part of $80,000, a 3/4 reduction. But what happens in 2031? It's only a 2/3 reduction. And so the assessed value is $35,700, way bigger than it was in 2025. Remember, for the average homeowner, the net assessed value was actually lower in 2031 than it was in 2025. For the lower valued homes, it's higher. When we come down to the net tax bill after making all the other changes, all the other calculations, what do we see? We see a tax bill of $842, which is higher than it was and higher than it would have been. So for lower value homes, this is not a tax cut under any definition. Well, that's an idea about what happens to the homeowners. And you've seen I've clicked through a couple of extra slides. If you take a look at the AARP Indiana website, you can find everything I clicked through, which has summaries of everything I've said. Each slide has a description on it of what I said about that slide. Let me give a little plug for some papers I have written for the Indiana Fiscal Policy Institute, indianafiscal.org. Under news and publications, you can find them. In 2024, I wrote a history of property tax policy over the last 50 years and an explanation of what COVID did to our property tax. And then just last fall, put out a paper about this property tax reform here in 2025. If you're really interested in this sort of thing, there is a lot more information there than I can talk to you about in the time we've had together here. So thank you very much for listening, and thank you to AARP Indiana for giving me the opportunity to talk to you about Indiana property tax reform. I'm Larry DeBoer from Agricultural Economics, retired, Purdue University. Thanks very much.
Okay, thank you so much for that presentation, Larry. I'm always so impressed with that information, so appreciate that. It's very helpful to have a better understanding of how we got to this point. And our next guest, Jamie Bolser and Campbell Ricci, will be able to build on that understanding. So I'm going to introduce them here. Jamie Bolser serves as the Director of Government Affairs with the Association of Indiana Counties. She has more than 25 years of diverse local government experience in both elected and appointed leadership roles, including overseeing the budgets of all Indiana local government units while serving as budget director and later as Deputy Commissioner and Chief of Staff at the Indiana Department of Local Government Finance. Campbell Ricci serves as the Policy and Financial Resources Director for Accelerate Indiana Municipalities, known as AIM, where he serves on the legislative team and provides technical assistance to the membership. He joined AIM in the fall of 2019. Prior to working at AIM, Campbell worked at the Indiana Senate as Deputy Policy Director. Thank you both so much for joining us. Welcome, Jamie and Campbell.
Thank you for having us. As we get the slide up here, again, my name is Jamie Bolser, and I'm the Director of Government Affairs with the Association of Indiana Counties, and pleased to have Campbell Ricci with me. He's the Policy and Finance Resources Director for AIM, or Accelerate Indiana Municipalities. So we're going to, on our agenda is to discuss the property tax reform and local income tax reform. And I know Dr. Larry DeBoer just went over some nuances in the property tax reform. So the first couple slides that we'll probably go through a little bit quicker. So starting with the property tax reform, one of the things, as he just mentioned, it phases out the homestead standard deduction. So you really didn't see a change in this too much from pay 25 to pay 26, but you can see as this further implements that standard deduction amount will phase down. The flat homestead deduction did have a higher impact on lower assessed values because it is that flat amount, as Larry DeBoer also mentioned in his presentation. Moving on to the next slide, adversely, the homestead supplemental deduction percentage is increasing. Part of the reason for that is because under the old property tax system, it wasn't necessarily designed to keep up with the market values that were increasing year over year that we've seen really since post-COVID. So with the larger market increases in valuation, it just wasn't, since it wasn't as a percentage, it wasn't keeping up with the rise in assessed values as a result of the market going up. But after beginning payable in 2031, 2/3 of every homestead property's assessed value will be deducted. Moving ahead, Senate Enrolled Act 1 also created and phases in that increase to a 2% circuit breaker deduction. What that means is residential property that isn't homesteadable, so like rental, single-family dwellings, agricultural land, apartment complexes, they will now see a phase-in of a new deduction. This will lessen that overall tax base. And with any deduction or exemption, what you see is there's just some changes of where that tax liability is being shifted to. Then the Senate Enrolled Act 1 of 25 and this most recent session, House Enrolled Act 1210, it does convert certain deductions to credits and creates a new credit. So with beginning in payable 26, the over 65 deduction of $14,000 shifted to a credit of $150. The blind disabled, previously a $12,480 deduction, it shifted to a flat $125 credit. Then, of course, that new homestead supplemental of $300 or 10% really, but not to exceed $300. Beginning with taxes payable next year, the veterans deductions are also being shifted to credits. Now, the difference again between a deduction to a credit is the deductions again just shifts around that liability to either other homeowners or other taxpayers and property tax types. However, the credit is an actual dollar for dollar savings to the home or the property that they're applied to, but it's also a proportionate loss to all of the underlying governmental units. So moving ahead here, specifically, let's talk about that over 65 credit. With the legislative changes from the deduction to the credit, you also see other eligibility requirements expanded and changed. So many of the previous restrictions were largely removed. At age 65 or over, on December 31st of the prior year, the taxes are first due and payable. That's an eligibility requirement. That has not changed. You will want to check. Everybody gets what's called a TS1 form. It's a taxpayer information statement. It is mailed either with your property tax bill or the duplicate of your tax bill if you are paying through escrow by chance, or call your county auditor. Ask them, hey, do I have the over 65 credit? Make sure that you have that on your tax bill. The income limits were raised from $30,000 for single filers and $40,000 for joint filers to $60,000 and $70,000. So it more than doubled the income limitations. The assessed value limit of $240,000 that previously was there for the deduction eligibility, that's been removed. So if you previously did not qualify, you may now, because of a lot of those restrictions being removed or increased. Then there is also what's called an over 65 circuit breaker credit. That's a year-over-year tax liability cap that cannot exceed 2%. And that takes away all of the other requirements. It simply looks at what is my tax liability net compared to the prior year. The income limits also were raised to $60,000 and $70,000. But I will also say uniquely, the over 65 credit does allow for cost of living increases, which aren't necessarily there for the over 65 credit, but year over year, you will see those income thresholds begin to expand. It's always important to understand the order of operations to calculate a property tax bill. And if you look beginning on line 4, that's where the property tax caps currently hit. That's again, that direct credit to the taxpayers and a direct loss proportionately to all the local units. But anything listed from 4 down qualifies as a quote unquote tax cap or circuit breaker credit of some sort, because they are very similar to how they impact the taxpayer compared to how they also impact that underlying unit. Moving ahead, if we put that order of operations in play, you can see here what we are looking at. Now, differently from Dr. DeBoer, he showed you the impact from 2025 to 2031 under the old system compared to 2031 under the new system. I'm going to show you the year-over-year impact from taxes due and payable in 2025 to taxes due and payable under 2026 under the new system, where again, that 25 was under the old system. So in looking at this, as we go down, you can see the gross assessed value is close to that statewide average assessed value of 230. That is standard then for that example 1 for 25 pay 26. We're keeping that flat at 230. Where the very far right column is again comparing the new system for pay 26, and we're showing an increase there of 243,800. Just to show you the example 1 is basically saying if all things were the same, what does this actually do? Where then the second example will show you what does this do with certain changes in the assessed value and the tax rate. So then we apply that homestead standard deduction. You can see from pay 25 to pay 26, that stayed flat at 48,000. Keep in mind, Dr. DeBoer, he showed that to begin to phase down as 2031 became effective. Then the supplemental homestead deduction is applied. For pay 25, that was 37.5%. That did increase, as you can see there in example 1, to 40% for pay 26. And then you can see that supplemental deduction increases in example 2 to keep up with the changes in assessed value now. The over 65 deduction, you can see a 14,000. That's applied in the first column where it's removed moving forward just to show you applicable changes. And then you can see the total deductions are added together and then subtracted from that gross assessed value. So you can see that tax base then. Then we've got the tax rate that's applied, and then you take that times the net assessed value to get that gross tax liability. Moving down, you can see where the property tax credits are applied. And if you looked at the little chart over to the right, you can see how the 2,300 for the 1%, and I'm sorry, that should say 1% across the board. It should not say 1%, 2%, 3%, because this is all 1% assessed value. But you can see the 230 times 1%, 230,000 times 1% is that 2,300. That stays stable for the example 1, and then it increases as the assessed value increases. But since the gross tax liability is over that 2,300 or that cap, that's why the difference is applied as a credit there at 143.88. And then you can see moving ahead, as Dr. DeBoer also showed, that increases moving forward. The over 65 credit now, you can see that's 0 for pay 25, but then at 150 as it's implemented. And then the new homestead credit, again, is 10% up to $300, and you can see that applied. And then we get to the subtotal of the tax liability. Well, for pay 25, it was $2,300. And then moving for pay 26, in both examples, the over 65 circuit breaker credit is not applicable. Again, why? Well, if you look at the very bottom there, where it says 23 pay 24, that's that prior year tax liability that's compared. And since that was 2,200, if you take that times a growth quotient of 1.02, the tax bill calculation there is saying, wait a second, we're going to give you $56 credit because there is a cap there that doesn't allow you to grow more than that 2%. And then you can see the total tax liability year over year. And you can see in each of those examples, it is a year over year decrease to the taxpayer in this example. But I just wanted to show you how that circuit breaker credit was applied. Moving forward, there has been multiple bills throughout the years that has capped or put a ceiling on what's called the maximum levy growth quotient. That's just saying how much can we kind of raise that levy or the amount of revenue to be generated from property taxes. They've capped that. And you can see in pay 24, it would have been a 5% growth. However, it was capped at 4%. All the way through pay 26, it was capped at 6%. It would have been 6%, but it was capped again at that 4%. Next year, moving forward, that levy is allowed to grow because that was sunset, and that levy is allowed to increase the full 6%. What does that mean? Well, higher certified net assessed value ultimately will mean lower tax rates. Lower levies also could mean a lower tax rate. But again, as that levy increases, say from 4% to 6%, and if that outpaces or is more than the overall certified net assessed value, keep in mind that's going to continue to decline possibly as these phase-in deductions occur. It could result in that higher tax rate, which again goes to Dr. DeBoer's point of we're going to be moving from an average statewide tax rate of about $2.50 all the way up to that $3 limit. And moving on, this is just to show you debt issuances is a common reason why tax rates would grow even if the total assessed value outpaces levy. You can see from this slide that 88.58% of all debt issued statewide using property tax is issued by schools. Cities and towns account for 4.76 and counties at 2.38. But you will also look at the chart that is referenced there. Year over year, you can see cities and towns allowed the debt that's backed by property taxes to decline over 20%. So they allowed that debt to fall off. Counties decreased 2.6 million or by just over 3%. But you can also see townships did increase their debt almost 19%, libraries almost 15%, schools increased 171 million year over year at 6%. Moving ahead, this is the total certified levies. It just depicts what those levies are, which are determined on the local level. They're locally based decisions. Counties as a unit of government saw the lowest change, with conservancy districts and townships seeing the largest percentage increases, and schools showing the highest amount of change at 268 million. I will say the unit type special there, you see that increase 10.74. There is a special outlier due to that increase, and that has a direct correlation to Health and Hospital of Marion County. So it wouldn't necessarily impact your counties quite the same as what it affected Marion County. Moving on to the next, this is the total certified net levy. So this is after all of those. Remember that line 4, property tax caps and below with all of those new credits. And I said it's a proportionate dollar for dollar loss, as it's a reduction for the taxpayers. It's a loss for those local units. So this shows you, it's that comparison of the previous slide to this slide that places those certain credits into place. And you can see how that really suppressed the year-over-year collections. And I will now hand it over to Campbell.
Well, thanks, Jamie. I know all of you are probably super excited about all the property tax changes and your heads are already swimming, but fear not, because in addition to reforming the entire property tax system, we also reformed the entire local income tax system in the same bill, which made AIM and AIC's sessions very exciting. So this right now is the current local income tax structure that you all are living under today. Under the current local income tax structure, there's one local income tax rate that's the same for everyone who lives in the county, and that's broken up by expenditure category. And the primary ones are certified shares, which is just general purpose revenue for all units of government in the county. Economic development, which is just for economic development purposes, and that only goes to counties and cities and towns. Public safety, which also is primarily dedicated to counties, cities, and towns, as well as other public safety entities. And then these last four expenditure categories, which go to the jail lit, the EMS lit, court services lit, and the hospital lit, all of those go directly to county governments who have passed those and provide those services. So that's how we do it today. It's broken up by expenditure category, and once the county adopting body sends it, it's distributed by property tax levy to all of the units who are eligible for each one of those rates. That was the concern that they wanted to deal with in the local income tax reform. They didn't like it being tied to the property tax levy. So in the new system, you will see that it is tied to population in all the different cases. I'll also point out something that Dr. DeBoer already mentioned. Right now, you have a property tax relief rate, which the majority of counties in Indiana have a property tax relief rate or a levy freeze rate, or sometimes both, that fund credits on tax bills. That is being repealed in the new local income tax system that is set to roll out in 2029. And depending on what that rate is set at, and also the how many tax caps you have in your county, that will have varying effects on your actual tax bills. But you could see some increased pressure on property tax bills as a result of that going away. The last piece of that is the special purpose rate, which most of these, they're adopted especially by statute, and they most of them are to fund jails also. Before the jail lit and the normal expenditure rate existed, they will carry forward unchanged. So I mentioned here, these are the maximums for all of these different rates. The current maximum expenditure rate, so that's the rate that actually raises revenue for local governments, is 2.5 currently, and you can raise an additional 1.25% on property tax relief on top of that, meaning the highest rate you can actually pay is 3.75%. But from the local government perspective, the most they can really raise in revenue is at a 2.5% level. In the new local income tax system, before I go into that, go to the next slide. This is what your rates look like statewide. You'll see there's a lot of variability on what the local income tax rate is. It looks like for Vanderburgh County, you guys are not among the higher ones in the state. A lot of the more rural counties have put a lot more of their rate into property tax relief to control property tax growth, but that's probably not as big for you all. And on average, the rate is 1.9%, right about at the current moment. But everyone will need to, every county and many cities and towns will have to readopt the local income tax rate under the new system in 2028. So this is what the new local income tax system will look like. And instead of being set up on expenditure categories, it's now broken up differently for different government units. So now there'll be a rate solely dedicated to county services, up to 1.2% that's adopted by the county council, a rate that's just to fund fire and EMS services in the county, up to 0.4%. That revenue can go to the county government if they have EMS services. City and town governments have fire or EMS services, as well as fire territories, fire districts, township fire departments, and volunteer fire departments. There's also a rate of up to 0.2% for non-municipal units. That's for every other type of unit, including your libraries, your townships, your transit districts, conservancy districts, airport districts, any of those things that are applicable in your area will now need to be funded through that rate if they're receiving local income tax rates revenue. All of those combined can't exceed 1.7% total. Obviously, it can be less than that, and all of those rates are set exclusively by the county council. With the rate for municipal services is different. Large municipalities, so in Vanderburgh County, it'd be just Evansville, have the option to adopt their own rate that only applies to the citizens of Evansville of up to 1.2%. Or they can choose to join with the entire county and have the county council adopt a rate for all municipalities in the county. And in Vanderburgh County, there are only two, just Evansville and Darmstadt. And they would basically break up that rate based on their population, with the county retaining a portion of that rate based on the proportion of the county that lives in the unincorporated area, if they go about it that way. So Evansville basically may have a different rate that people pay living inside the city than that you pay in the rest of the county, but that will be determined by the decisions of your city and county leaders when they move to final adoption in 2028. I mentioned this briefly, but this is who adopts each of these. For the majority of the rates, your county council is responsible for the entirety of the rate, but I will say for the majority of the population, Vanderburgh County is in Evansville, and so the city council may be responsible for a large portion of what the actual rate will be in your community. And now, why this is important when we talk about the property tax system is, of course, property taxes were reduced in Senate Bill 1, and all local governments are feeling that. The local income tax system reform was provided in part to help deal with that. So there may be discussions locally about, do local income taxes need to be changed, increased to deal with those losses, as well as many other factors that go into setting those rates that you all may be party to as those conversations go on locally between now and 2028, when that rate actually needs to be set. And so I just think that's important to be aware of inside of this entire conversation. In part, what Senate Bill 1 did was put more pressure to shift to local income taxes off property taxes, as we see less growth in property taxes than we would otherwise see in an environment where costs for local governments are still increasing at the rate they were before the property tax reforms. I think that takes me pretty well to the end of the discussion of the new local income tax system. Really appreciate AARP for having me and Jamie back again to talk through this with you all.
All right. Campbell, Jamie, thank you both for that incredibly helpful information. Really appreciate it. I now want to introduce our final guest speaker of the event to provide a brief overview of our residential property tax bill, Vanderburgh County Treasurer Brian Girth. Brian serves as the Vanderburgh County Treasurer. Previously, he served as the Vanderburgh County Auditor and Chief Deputy Auditor. Prior to his service in county government, he worked at Old National Bank. So we appreciate you joining us today, Brian, and I will turn things over to you.
Okay, thank you, Addison. My name is Brian Girth, and I'm in my second year as treasurer after spending the last 9 years as the Vanderburgh County Auditor. I've had the privilege of working on both sides of the tax calculating and tax billing system process. Next slide. We're here today to discuss the Enroll Act, which made significant changes to the state property tax billing starting this year in 2026. This has kind of already been mentioned by Jamie and Campbell, along with Dr. DeBoer. The next slide talks about the differences between deduction and credit. Again, I know a lot of this has already been mentioned in this presentation, but a deduction reduces the assessed value on a taxpayer's property, while a credit reduces the tax liability or the amount to be paid on their tax bill. We have listed a few examples of the deductions and credits that are available to taxpayers on this slide. I would like to point out that the over 65 credit used to be a deduction. The blind or disabled person's credit used to be a deduction. Though the supplemental homestead credit is new for 2026, and I will go into more detail on this a little bit later. The next slide, this has already been mentioned in the presentation, but this shows how the homestead is going to be phased out by 2031. So it's basically been $48,000. It'll drop from 40 to 30 to 20 to 10 and all the way to 0 by 2031. While the homestead homestead supplemental percentage will continue to increase and cap out at 2031. This is separate from the supplemental homestead credit. The next slide shows the new supplemental homestead credit does not replace a deduction, but is in addition to the standard homestead deduction. A person who has applied and qualified for a standard homestead deduction will see an additional credit valued at 1/10 of their tax liability up to a maximum of $300 annually. And I'm sure this shows up on your tax bill here shortly. The next screen shows is the remittance coupon for your tax bill. These bills are mailed out once a year, usually in April. It will include both the spring and the fall installments, and then also has the bottom section shows the taxpayer's copy. Please note you will not receive a reminder bill for the fall. So both coupons will be used for the full year. In this example, looking at the spring installment remittance coupon, it shows 0 because this taxpayer has already paid their spring bill, and due to the timing, our system has already updated the tax bills online. But you can see the fall installment remittance coupon shows $496.59 is due. The taxpayer's copy shows total tax for the spring and the fall that was due, along with the other assessments that were due. If there were delinquent taxes or penalties due, it would also show the taxpayer's copy of the coupon. The next slide is the TS1. This has kind of been mentioned, but we'll go into a little bit more detail, and you can see the form here. This is usually the second page of your tax bill. This contains the detailed breakdown of your property tax liability for the current year and the prior year, along with the calculations and credits that were applied. In this example, line 1A will list the value of your homestead property. If you property assessed on the 2% line, it would be on line 1B, which is for other residential property or agricultural land. If you have property assessed on the 3% line, it would be on line 1C for other property that is also included. This also includes the personal property. So line 2A will show your total deduction for prior year and current year. To get those breakdowns, look to the bottom right of the page in table 5. You can see that the over 65 deduction went to 0 for 2026. If you remember earlier, we stated this deduction was replaced by a credit. If you go back and look at line 4C, you will see $150 credit for 2026. This is where the credit shows for replacing the deduction. If you go back to table 5, you will notice the homestead deduction amount is the same prior year, but on next year's bill, you will see that number change from $48,000 to $40,000 for 2027. The supplemental homestead did increase for 26, and you will continue to see this amount increase for future bills until 2031. Now that we understand the total deductions, let's go back to table 1. Your total deduction are listed on line 2A and are subtracted on line 2 to get your net assessed value on line 3. Then that amount is multiplied by your taxing unit's rate on line 3A. This percentage is different for each taxing unit in the county, so it really depends on which township you live in throughout Vanderburgh County. Once that calculation is made, line 4 will show the gross tax liability. Then the credits are applied. This example shows on line 4A they're receiving a local property tax credit. This is money being funded by local income tax. So that was mentioned earlier in the presentation. This will expire when property taxes become due in 2029. On line 4B, they are receiving a property tax cap credit. I've already mentioned the over 65 credit on line 4C. Then they are also receiving the new supplemental homestead credit, which is listed on line 4E. All those amounts are deducted from line 4. Then on line 5 is the net property tax liability due in 2026. The table 2 lists the property tax cap information. The first line is 1% of the gross assessed value from line 1A. The next line is the school referendum tax that is figured outside of the property tax calculations. Those two numbers added together is the maximum amount the taxpayer would pay. Table 3 gives the breakdown by tax unit of where the money will be distributed for this tax bill. So it shows the current year and the proper breakdown for the county, the school, the city, the library, township, and special unit. The special unit would include the airport and the levy authority. And then lastly, table 4 is the other assessment breakdown for the Pigeon Creek watershed. This is a new other assessment for started in 2025. Next slide. You can go to the next slide. The billing information again. Again, bills are mailed out in April with both the spring and the fall remittance coupons attached. Taxpayers should only send in the spring coupon when paying in the spring unless they decide to pay for the whole year. Property taxes are generally due May 10th and November 10th every year. Unless the 10th falls on the holiday or a weekend, then it would be the next business day. If you do not receive your tax bill, check to see if the mailing address is current. If an address change needs to be made, you can contact the auditor's office or do it on their website. The next slide are different ways you can pay your tax bill in Vanderburgh County. We accept them online with credit or debit card or by e-check. I've listed our fees, and I'm happy to say that I was able to get our vendor to lower their fees once I came into office last year. You can also pay over the phone, in our Dropbox, by mail, at Old National Bank during specified times of the year, and of course you can pay in our office. The next slide, I've added this slide. It's a slide understanding the property tax process and the budget process. It is a year-long process between the assessor's office, auditor's office, treasurer's office, and approval with council. I'm not going to go into great detail with this slide, but I've added the slide in case anyone is curious about where we start and how we get to the end of the property tax cycle. The last slide lists the phone numbers for the auditor's office, the assessor's office, and the treasurer's office in case anyone has questions regarding deductions, assessments, or payments, or how to pay your property taxes in Vanderburgh County. So in closing, I just want to thank Addison and everything with the AARP for allowing me to speak about property tax bills. Thank you.
All right, Treasurer Girth, thank you so much for your time today in walking us through the ins and outs of a Vanderburgh County homeowner's property tax bill. Really appreciate that. So with all this information under our belts, what's next for you as a property owner is probably what you're asking. As you've heard from local leaders during today's event, there are still a lot of unknowns about exactly how SEA, Senate Enrolled Act 1 from 2025 will impact you on a local level. We will continue to watch how communities take action, as well as monitor changes that may come at the Indiana General Assembly in future legislative sessions. So in 2025, the General Assembly session, AARP Indiana was successful in working to ensure that our voices were at the table to help older residents stay in their homes as they age, preserving housing affordability and stability. So Senate Enrolled Act 1 from 2025 contains language that allows counties to establish a program for qualified individuals to defer $100 to $500 of their property tax liability annually, up to a total of $10,000. The taxes would be paid back with interest when the home is sold or the estate is settled. AARP Indiana supported this deferral program that offers a balanced approach to the challenge of funding vital community services while providing tax relief to those who need it most. To help state leaders better understand how increasing property taxes impacts older homeowners in Indiana, in December of 2024, AARP commissioned a poll of Indiana voters age 50 plus who own a home in the state. The findings showed that after seeing steep increases in property taxes over the past several years, older Hoosiers are increasingly worried about the financial pressures these taxes are causing and looking toward state leaders to provide some financial relief. To help understand how rising property taxes are affecting older Hoosiers, AARP Indiana commissioned this statewide survey of homeowners age 50 and older. This data helps us advocate for meaningful relief that reflects the real experiences of our members in Hoosiers 50 plus. We surveyed 1,001 registered voters age 50 and older who live in Indiana and own their primary residence. The survey revealed several things. One, that 84% of older homeowners have seen their property taxes increase in the past 3 years. 2/3 say these increases have impacted their household budgets. This is a clear signal that property taxes are becoming a financial strain. Support for property tax relief also crosses party lines. Whether Republican, Democrat, or Independent, older voters agree lowering property taxes should be a priority for lawmakers. There's strong support for practical solutions. Nearly 3/4 of respondents support a new statewide tax credit for older homeowners, and even more support the option to pay property taxes on a monthly basis, making it easier to manage household budgets. This summer, actually, lawmakers on the Fiscal Policy Interim Study Committee will hear a report from the Department of Local Government Finance about county and online payment systems that could let taxpayers pay their property taxes monthly. And property taxes don't exist in a vacuum. Rising costs in areas like home repairs, insurance, transportation, and medical expenses mean that even small increases in property taxes can tip the balance for older adults. The majority of Hoosiers say future increases could make it hard to afford staying in their homes. All right, we have arrived at the conclusion of our event. I know that was a lot of information in a very short period of time. Luckily, this is recorded and you can come back and check this out on our YouTube and Facebook pages. I do want to share several resources that are available, including the Indiana Department of Local Government and Finance's Tax Bill Estimator. The Indiana Counties Directory also is a helpful resource with additional information. If you have questions about deductions or relief eligibility, we encourage you to reach out to your county auditor, as they will be the best point of contact where you live. And you can also visit the AARP Foundation website that you see on your screen. This is a good resource as well. All right, with that, now I'd like to turn things back to Vicki Small. Just bring her on the screen to close us out for today and invite you to join AARP Indiana's efforts to advocate for Hoosiers 50+. Vicki?
Yeah, so if you're interested in joining us as we our efforts on this issue, or really any other issues that we deal with, the first thing you can do is to sign up to receive our advocacy alerts. And so to do that, you can scan this QR code that you see on your screen, and it will take you where you need to go to sign up. You can also sign up to receive text alerts from us by following directions that you see on the screen right now. I'll give you a moment to take a picture of it if you want to. And lastly, you might have seen our team members in their red shirts at various events around Evansville. We do a lot of things to raise awareness about quality of life issues for those aged 50 and over living in our community. So we invite you to connect with us anytime you see us, and can sign up to receive information at aarp.org/in. Thanks to all of you who joined us, and thanks especially to our guests. I did have a copy of my tax bill as I was following along, and that really helped me understand a very, very complicated issue. So thanks again, and hope you have a great rest of your day.